Good afternoon, everybody. My name is Henry Rucker, and we are filming episode 5 for NAREB's podcast. Once again, this is NAREB podcast, episode 5. Today, we're going to be coming to you. We're going to be talking about wealth management, money management, and legacy building. To my right here, I have Richelle Taylor. She is the NAREB Twin Cities chapter founder. Let's give her a round of applause. Then we have BJ Wild. He's independent agency owner. And we have Tamba Johnson. He's with wealth manager MBW Group. Welcome, you guys.
Thank you for having us.
Thanks for having us.
We appreciate you taking the time to talk today. So, Gabe, we're going to bring that first slide up real quick. When we talk about wealth, we talk about money management, we talk about legacy. What do you guys think about as individuals? And also, how can we look at this from a community aspect? What does the community think about when we look at what is generational wealth? Let's start with you, Richelle.
I think the idea of generational wealth is really just setting our kids up to be in a better position than we were. Before we started this, we were talking about the people that were before us that gave us information that set us up on a better path. My grandpa's lesson was, if you don't have enough money to pay for it, you don't deserve it. That was impactful. You were talking about your dad and some of the lessons that you learned from him. So to me, it's being able to pass something along, whether that's a property that you're passing on, whether it's stock, life insurance, whatever you're passing on to the next generation, so that they're not sitting and setting up at a level where they have nothing and they're trying to figure it out. That's generational wealth.
Okay. And what would you guys like to add to that? Let's start with you, BJ. What would you add to that?
Well, me personally, I'm an insurance agent. So coming from the insurance side of it, when I think of generational wealth, it automatically goes to life insurance. That's kind of the reason why I specifically got into this business. Actually, a few years ago, my great aunt passed, and it was over a month before we were actually able to get her buried, because it was, my dad and uncles going around trying to scrape up here and there, see what you could put together. And it's just, I didn't know about this business at that time, but I realize now that when you're going through that, you don't want to have to worry about anything else besides breathing and grieving and just trying to get over it. And if you can set yourself and your family up to be able to take care of these things in the worst times, it takes so much off of your shoulders. That's just, like I said, being an insurance agent, that's where I come from. I'm here to save people those terrible times, and hopefully you ain't got to get kicked out of your house and things like that when bad stuff happens.
Okay. And Tom, what would you say? What would you like to add to that?
Yeah, I think, it's a great problem that we have, especially in our community, talking about life insurance and death. And generational wealth is understanding how to pass money down. I think a lot of times we don't understand it. We've not been taught it. It's something that, we think, hey, you work hard and you can pass some money down, but that's not generational wealth. That's really passing a little bit of money down. But how do you pass property? How do you protect yourself? And, estate plan. Everyone has an estate. It's not that you need to be a millionaire to have an estate. Everyone has an estate. And those simple little things of avoiding probate, make sure you got the will right, that there's not a big fight over who gets what. That's understanding generational wealth.
Right. One thing I like to add, and I'm going to throw this out there real quick. We kind of talked about this in the room about GoFundMe pages, right? So we want to make sure we're not having listeners here have to have a GoFundMe page. How does life insurance work? If something was to happen to a loved one, how does life insurance really work? I think some people misunderstand life insurance. Do we pay tax on life insurance? So if I have a $300,000 policy and I have 3 kids, could I leave $100,000 to all 3, or could I leave $300,000 to just one? But do they pay tax on that money?
For the most part, you do not. There might be an exception here or there, but for the most part, no. Taxes is your life insurance is something that is completely separate. Even if you have creditors come after you, go bankrupt for whatever reason, you have creditors come after you and they taking everything you got, they can't touch your life insurance. Life insurance is it's mainly what it is. It's a vehicle to be able to move money around. Tax-free, tax-deferred, things like that, depending on kind of how you set it up. But no, if you want to leave your kids, if you have 3 kids, you got a $300,000 policy, you can set it up where each of them will get that $100K, and you don't have to worry about taxes or anything. Life insurance is pre-tax.
Okay. And Tamba, what would you say, why do people that you maybe talk to do not buy life insurance or do not buy maybe enough life insurance?
Because they don't understand generational wealth. Like, even again, life insurance, the proceeds are tax-free upon person's death. The only times you'll be taxed on it is if you're taking loans out, and people take loans out before. So it's understanding term insurance and also permanent insurance, which one's valuable. But a lot of times they just don't understand that, hey, it's pretty inexpensive. But the hard part is, your health comes into it. And so I always say to people, you're one day away from being uninsurable. And, that's sometimes why people don't do it. And they're afraid of the cost of it. But the cost of not having life insurance is so much greater than the cost of having life insurance.
Okay. And Richelle, from a real estate broker standpoint, when you're out showing houses, you get that offer accepted, your buyers are going to buy a house for $400,000. Do you think that they're thinking about, hey, I'm going to maybe live in this house for the next 5 years or 30 years, why it might be important for them to protect that asset? Because that's what we're trying to do when we do build generational wealth through life insurance. Or what do you normally hear from buyers that finally get that offer accepted and are saying, oh, should I buy life insurance, not buy life insurance?
I don't think the conversation comes up, and no, I don't think that people are thinking about it at all. When I'm talking to people when they're getting into a house, I have those conversations with them about how is this house going to serve you, what's the intention, and what are your goals, talking about equity and how to be able to leverage that. But no, we've never had a conversation about now that I'm here, I'm going to get my life insurance in place also. One of the other things that I was thinking about that we talked about before we got in here was the cost of life insurance. I'm fairly young. I've had mine for, 6 years probably. And I'm pretty sure I pay about $500 a year for $500,000 of insurance. So just as an estimate, it's not super expensive. And I think that people just don't know that and probably are not comfortable going in and asking those questions. There's, some invasiveness, physicals, things like that. But people just don't really know what it can do or what the costs are. It's very, very low cost compared to anything else, with the return being what it is.
So what made you get life insurance at such a young age?
So I actually, when I got married, I said that I'm more of a financial person. So I said it was my nesting. It was my version of nesting. When I was getting married, I knew that I wanted to have kids. I knew I wanted to stay at home with my kids. I actually took the insurance classes and license because I was going to do that to stay at home. But my financial nesting was to get life insurance on my husband at the time. And we had life insurance enough to be able to pay off the house and to be able to, based on how much we lived, what our budget was for the year, I calculated that against how old the kids were and how long I was going to want to stay at home with them if he, passed. So I had enough life insurance to be able to pay off the house, be able to stay at home with my kids, and make sure that we had enough income coming in from that. Unfortunately, after I got divorced, my husband did pass. And I kept that insurance going. I kept paying for it. And it was a time and a place where I didn't have any money. I was a stay-at-home mom. I had to figure out how to take care of my kids and pay my mortgage. I certainly didn't have extra money. He was a smoker, so his insurance was more, even though we were young. It was $717.60. I remember paying it painfully because I didn't have it, but I paid it because I knew it was important. I knew that that was my safety block when I didn't have anything else. So I made it happen. If I didn't make anything else happen, I made that happen. And when, unfortunately, he did pass, that was money that we were able to leverage and use. And from that, it expedited my savings that I was doing on my own with just real estate and stashing, squirreling away money.
Mm-hmm.
It expedited that. And I was able to create a legacy now for my children, that we have a holding company with their initials as the name, and any property that I buy is for them. We have a trust. So the idea for me was safety and being strategic, and I knew that I wanted to live away, and I knew that was a vehicle.
Okay. BJ, you're going to say something. Go ahead.
Yeah, sure. I just when you were kind of addressing Richelle and you were asking what made her want to, we were kind of talking about this in the hall a little bit as well. And one of the main reasons why I wanted to do this podcast is just because I know that us as Black people, are not taught these things, taught how to use insurance, or how to leverage equity, how to be able to create that generational wealth. And just the fact that we're not taught these things, that's, 90% of the reason why I'm in this business, and I want to be able to help out in any way I can, just to be able to help people to kind of get an understanding of it. And also too, the second point was, another thing that people don't understand about life insurance, there's two different kinds of life insurance. There's whole life, which is permanent life insurance. You have a sub account that builds up and you can, do other things with. But there's also term insurance, which term insurance is going to be a lot cheaper. That's going to be something that kind of along the lines of what Richelle was saying, something that could be a lot more affordable. And it has its purposes. One of the main things that term insurance is good for is debt protection. Mm-hmm. People don't like term insurance because it only lasts a certain period, it's at 10, 20 years, whatever you take, and then after that you don't have insurance. But if you have, if you're young family, 2 kids, you got house payment, car payment or whatever, you don't have much money, and you got a $500,000 life insurance policy that you're paying $30-$40 a month on, you can probably swing that. But if something were to happen to one of the money earners, then that throws the whole family into disarray, as opposed to, 10, 20 years down the line, they're like, oh, I'm not going to have it. Well, 20 years down the line from now, the house is going to be mostly paid for. The kids are going to be grown. The car payments hopefully will be, done with at that point. So you don't need quite as much there. Another good example is kids who are taking out student loans. If you've got, if you're if you're a parent, you're signing up for $100,000 and $200,000 worth of student loans, especially while they're 19 years old or something, get a $20 policy on them just to make sure that loan doesn't, all of a sudden impact you if anything were to happen.
So let me ask you a question on this, because I think Richelle brought up a good point. I'm going to start with you, Tom, on this. I think sometimes that people, who can we buy life insurance on? So if I'm a mom or my dad or I'm a spouse, can I buy life insurance on individuals, all my children, my spouse, my partners? How does that work?
So it's love, blood, or money. Those are usually the criteria to buy insurance on someone. Getting back to both points, like, we often have different stages where you need insurance. When the kids are young, you need some term. So a lot of times we'll do term and permanent on a person, because the term you can get a lot more, but also you get a little bit of permanent, because when that term passes and you don't pass away, it becomes a lot more cost prohibitive. But if you have that permanent growing at the same time, that's what helps people, because a lot of times people don't buy because it just becomes cost prohibitive, or they see it as, hey, I'm renting, and they don't want to do that. They say we're wasting money. But you can buy it on business partners, you can buy it on grandkids, things like that, and have people contribute to it. And it's understanding you can't buy a term on someone young, but you allow your kid to.
So define it when you say you can't buy term on somebody young. Like, what's the starting age of that?
Like up to 16.
Okay.
Because they obviously frown on, hey, my kid's only going to live 10 years. No, you got to buy a permanent policy on it. But you get to build wealth. And one trick that people don't understand on that, also, it doesn't get counted against your expected family contribution if your kid wants to go to college. So it doesn't count as an asset. Even though it is growing as an asset, it doesn't count as an asset when they use it. So
okay.
And what the actual term for it is, in order to be able to put insurance on someone, you have to have what's called insurable interest in them.
Okay, repeat that for the crowd.
Sure, actually, it's called insurable interest. And basically what that means is that you have to have an interest in this person living. Like, you have to be, it has to be somebody that you love, or a business partner, somebody like that you have a viable interest in them living. It can't be, your neighbor who pissed you off when he, ran over you,
right.
your whatever, and then you're like, oh, okay, I'm going to get a life insurance policy to take him out. No,
right.
You can't do that.
Okay.
It has to be somebody that you have an interest in them living.
Okay. I'm glad to hear that. So let's take this to a level where we're talking about young couples, right? They're not married, right? And they're buying a house together. How does that work? So would that be a party that they could actually buy insurance on if they bought the house together, but they're not legally married, but they're partners?
Absolutely.
Okay, thank you for that. Now, can I have more than one policy? So could I have Richelle mentioned that she had a policy on her husband. Could she have multiple policies on them? Or because I think sometimes people get confused as, well, I got a policy through work, but I can't maybe get a policy through an independent agency. Is that true?
You can have multiple policies on a person. It's understanding, again, talking to an advisor, making sure a broker so that you understand it. Because as you have multiple policies, there are break points. The more insurance you buy, it's kind of cheaper.
Mm-hmm.
So if you want $1 million, probably doesn't make as much sense to buy 5 of them because you're paying policy fees and things like that versus paying policy fees on one that's $1 million or whatever it is. So, but you can have multiple policies on people.
Okay, so the reason I asked that because I think this is going to lead us into our next part, the money management piece, right? Richelle talked about how she made sure that policy was paid on her husband, right? So how do we manage our money a little bit better to make sure we can pay our policies, but then also how do we manage our money so we're having the life insurance, but also maybe putting money away for retirement? Start with you, Richelle.
So I'm looking at this, the money management that we have up here, and we say all the time that things are simple but not easy. So I said that I did this by setting up a budget. I knew how much my bills were. I knew how much my mortgage was. I incorporate into my budget how I like to live. I like to travel. I don't buy purses. I don't go out to eat, but I'm going to do the things that I like to do. So I incorporate that into my budget realistically, starting with the things that I want to do, and then I go down from there. So prioritizing your needs, yes, what I want to do and also what I need to do. Setting aside an emergency fund, keeping reserves. I say keep reserves aside like you're paying a bill. Put it away, just like a bill. And so I think that idea of really being thoughtful of what you're doing, I think people have the capacity to save. We save all the time for the things that we want to do. So it's not as if people don't have the capacity to do it. It's why and the want to do it and what's at the end of it. What are you going to get for it? And really being thoughtful of what are you spending your money on. I think it's too easy right now to just swipe cards. We're all old enough that we didn't always have that. We had $20 in our pocket and we knew you didn't want to break the $20 because then it's gone, right? Instantly, $100 gone. So just being thoughtful of what you're doing and what you're spending money on and making better choices. And then if people did that, I feel like we would have more reserves. I know that a lot of times the problem is just not making enough, and that's a separate conversation. But
I'm going to pass this to Tamba real quick because I know he's studying for his Series 7. So let's say I work at Project for Pride and Living. I have a 403B, so, we're a nonprofit. But let's say I'm at an organization that has a 403B or I'm at a organization that has a 401k. Why is putting money away in retirement good for not just me, but for everybody that's listening, and especially for the Black community?
I mean, it's, putting money away is just because, number one, just with employment, you never know when your employment is going to end. So, again, having that rainy day of how do I support myself if I'm all of a sudden out of a job, not knowing people's marital status. We may not have that partner to lean on. But as we get older, everything just keeps going up. The economy, inflation's going up. It's just important to protect yourself so that you have options. It's all about options when you retire, whether it's in your 403B, taking out separate accounts, investing separately. The reason a lot of people don't invest outside of their 401k or 403B is a lot of times they feel, look, I want to save $6,000, but I don't have $6,000 in my bank. And just doing it daily, doing it monthly, understanding that, hey, $200, $500 over time, it really adds up. And it just becomes a habit. It's a lot easier than people think once they start doing it. But it's just super important because, unless you're a business owner, and even as a business owner, you don't control your income. You don't control your employment. So why let other people dictate if something happens, how you're going to end up? Why not save for yourself?
So let me ask you this too, and I'm going to pass it to BJ. Again, we talked about this with life insurance. If you could start with this too, BJ, if I pass away and I have a retirement plan through my employer, what happens to that money?
You want to go or you want to go? It depends on, do you do the proper estate planning things? What does your will say? Does it go to your spouse? It could. Does it have to go through probate? So a lot of times if you don't have a will, things are going to go through probate. People are going to fight through it. So, when someone gets divorced, did you change your will? A lot of times people don't do that, but go see your beneficiaries, whoever you list as your beneficiary. So it's always good to have a yearly checkup and say, hey, are my beneficiaries still the same person? Are you mad at your daughter or your son, and all of a sudden you're going to give them less?
You said something key there, and Pastor DeVJ here. Yearly checkups, you guys, is I think we need to be doing that on a yearly basis, verifying that who we have listed as beneficiaries are still, one, alive, and two, that we have a relationship with them. Go ahead, BJ.
Yeah, sure. To that point, that is something that you want to do with a lot of things, and definitely with your insurance, because every year things happen. People have babies, or people get divorced, or what, you know what I'm saying? You might have had your ex-wife as your beneficiary, but now that y'all, you always want to check up on that sort of thing. And then just to quickly touch back on the point that you had originally asked, Tamba, another important thing, or another good reason why you want to put your money away in your 401k and 403bs and stuff like that. The number one way to get wealth and to keep wealth, and if you ask rich people this, what is the number one thing they do to try to maintain their wealth? They avoid paying taxes. You avoid pay. That's what rich people do. They
do it good.
Avoid pay taxes at all costs. They don't want to pay them at all.
So tell me, how does, in putting money in my 401k, my 403b retirement plan, BJ, tell me, how do I avoid taxes on that?
Because all of that money is pre-tax that you're putting in there right now. All of that is pre-tax. So basically, whatever you're putting away, the government, again, this is something that the government can't even see or look at or bother to even touch at all.
Okay.
So you want to be able to, basically the same way they play the game, you want to be able to avoid as many taxes as possible. And if your check is this much, but you're putting this much of it away in pre-tax, then you're only getting taxed on whatever's left. This part here is still left untaxed. So that's, you want to avoid paying taxes at all costs.
Okay, so I'm W-2 with PPL. I have a real estate brokerage. Richelle has a brokerage. She's pretty much an independent contractor. How does she set herself for retirement? Richelle, what have you maybe done to set yourself for retirement since you're not working for a nonprofit such as PPL?
I have a SEP account. So a SEP account is self-employment
Pension.
So I have a SEP account. It's basically a 401k for self-employed people. It does offset the amount of money that I pay in taxes. Quick side note about the taxes for all the realtors and lenders: please get in your house first and then worry about not paying taxes, because people will, self-employed people especially, will write off a lot of their income, but then when you go to buy a house, if I made $100,000 but I wrote off $70,000, I have $30,000 that they're looking at for me to be able to buy a house. And I'm saying, no, I made 100, and they're saying, no, you made 30.
So what she's pretty much saying to you guys out there, if you're self-employed, they look at your net income. If you're W-2, they look at your gross income. Thank you for bringing that up. So with your SEP, who controls that?
I control it.
You control it. You working with a firm?
I do.
Okay.
Yep.
So what do you guys recommend? So for people that might have a W-2 job and have a little bit of a side business, could they do both? Could they have a retirement plan set up through work and a SEP plan?
You can do both. My suggestion, I mean, and it all kind of depends on the situation, but my suggestion would be, like, if you're like a salary employee or working employee, your first thing is your 401k. Then once you know that you can, easily take care of the 401k, then you want to set up an IRA to make sure that, again, once you get these two things right here, and they're successful and going, and you don't have to worry about them, then you really want to look at, a life insurance plan that's going to be able to not only maybe have something that you could pass down, but also something, like you said, with a sub account that you can use later on, help supplement your retirement, whatever the case may be. Here's
what's interesting. I always tell people, they like the word free, right? And typically, if you work at most employers, they're going to match what you put in, right? So if your employer says, hey, you put in 3%, we're going to put in 3%. To me, if you don't put anything in, you must not like the word free. That's just my personal opinion. When I teach, I call it a Henryism. So, but let's say now I have my life insurance, I have my 401k or a SEP set up. How do I protect all that? So Tom, I'll reach out to you. How do we look at estate planning? How do we set that up?
So, looking at estate planning 101, first thing is we'll always say, do you have a will? And then do you have a trust? There's different things, different types of trusts. Generational wealth will look at maybe can you do a dynasty trust so that generation upon generations can get your assets, and putting in different vehicles into it, whether it's your home, it's starting different savings accounts, putting it in there. So that's the things we always will look at. But estate planning is just understanding what do you have, where is it at, who's it going to, and making sure that everything that you want to put into those things, whether it's your trust, whether it's just savings vehicles, think you talk about if you have your 401k, your insurance, do you put your insurance into your trust? Those are things that we will always talk about.
Okay, I'm gonna ask Gabe to bring up a slide. Gabe, there's a slide there that talks about the net worth. If you could show that for us real quick, because I think what Tamba was talking about. So if I have an estate, I can put all these things in there, right, to protect it. And if you look at this slide, you guys, the family net worth for a black family is $17,150 compared to $171,000 for a white family. That's a big gap. How do we as blacks, especially we're talking about NAREB, right, which is the Black Affinity Group for Real Estate Agents and Professionals, how do we make sure the community understands that we want to protect our assets? If we're trying to build generational wealth, how do we make sure that when we put something in an estate, it's protected? Because I think BJ brought this up a little while ago. If you know the rules of the game, you know how to play the game, right? A lot of times we don't know the rules. So how do we make sure people understand there's nothing dangerous about an estate?
And the idea of IRAs too. I think IRAs and Roths.
It's seeking. First, it's getting over like the narrative, like I don't have an estate or I don't have enough money, because that's what usually stops people. I know I have people that I work with in insurance that we started 10 years ago, and now they're finally putting money into a life insurance policy, a cash value policy, and it's like time value of money. They've lost so much opportunity. We don't invest because it's like, well, I'm gonna lose money, yeah, but you also might make money. And it's just taking little baby steps of doing that, having conversations with people, then setting things up properly, whether it's great to invest money, it's great to have all this, but if you don't have life insurance, someone prematurely dies and they're the breadwinner. Now what? If you don't have proper disability insurance, 1 in 4 people are going to be disabled for over 2 years in their lifetime. Okay, now you're paying, bills and not understanding, well, I got disability at work. Well, people don't get it. Disability at work pays you 50% of your income.
Say it again for the crowd, please.
50% of your income. So if you have to give up 50% of your income, what are you giving up in your life? And people don't a lot of times have proper protections around it. And it is a sacrifice. It's money. But it's worth it. One part we've touched a lot on life insurance, but long-term care. Unfortunately, my mother had a stroke a couple of years ago, and we had long-term care set up for her. But the first 3 months, I was paying $12,000 a month out of my own pocket, and luckily I had it. But if you don't have it, now what? And if she didn't have insurance, you can't pay $12,000 forever, and it's a big deal, especially in the African American community. We just don't have it, but planning is the biggest thing. You have to be willing to plan.
So I want to ask a question because Richelle brought this up in the very beginning about maybe doing blood work, physicals, right? So if we explain to the group too, because I do think a lot of people don't understand how there's different types of insurance you could buy. So if I was to go get a physical and if I was to go have to take maybe a drug test, how does that differ from just a regular, maybe basic policy that's going to make sure that my home is covered versus what's the difference when I start taking drug tests and I have to get blood for insurance?
Well, every company kind of has it set up differently, but mainly what it is just like I was speaking about earlier. If you're having to go through the whole physical and the health check and all that, mostly what you're getting is a whole life plan, which is something where now, again, it's the difference of renting versus owning, basically. When you have a term policy, you have it 10, 20 years or whatever, it's basically you renting it. And after you are done with that policy, then Just like when you rent, you move, that you have nothing to show for it. Whereas in a whole life policy, you're buying a house, you're building up equity in it. So that's basically what that is. 9 times out of 10, if you're having to go through a physical and all that, you're getting a plan that you're actually going to have equity in, and it's going to allow you to leverage it and have options to be able to use it later on. Whereas if you're getting a term plan, it's a lot cheaper. And and like I said, it's great for debt protection, but it doesn't have those extra options on there too as well. So it all depends kind of on what plan you're looking at.
I think people, whether you have it's what are your priorities. So whether you want to do a term insurance or a permanent policy, even if you get a rated policy, you're still able to get insurance. If you're a diabetic, there's some companies that will insure you, some people won't, and it's still try because. If you're doing a permanent policy, what you truly are doing, you're being your own bank. You are saving money in your own bank and being able to use that money for further things. There's, income limitations for like a Roth IRA. And so when people are over that income, they can't contribute to a Roth IRA. Well, cash value life insurance is a Roth IRA on steroids. You can put whatever you want in terms of finances, and there's different types that you can use. So I think when people understand that insurance can be a very powerful tool to help you save money and take that. And there's many people that smoke marijuana. Some companies it's very rated. There's some companies it's not as huge of a deal. You get, it doesn't mean you're gonna be denied.
Well, I like that real quick because this is going to be legal, right? It's legal in Minnesota now. So let's make sure people understand they can still get life insurance, and they just need to probably reach out to somebody like yourself or BJ to talk about that. Yes, Richelle.
I was just going to say that we talked a little bit ago about just wealth creation in the United States. And the way that wealth is created in the United States is one, being able to make it and pass it down. So insurance and these vehicles that we're talking about, and property. There is so much nuance in getting a loan, in who you are and how healthy you are and how much money you have and how you want to live and what your goals and objectives are. I think that what's most important is don't talk to the person that's not doing it. Talk to somebody that is doing it, first of all, and then talk to somebody that can get you some advice, that can look at you as an individual and advise you specifically. What we are not seeing enough of is Black and brown people going and asking the question. Go to the right person, sit down with an insurance agent, sit down with the financial planner, sit down with the lender, look at your situation and prepare for that. Don't take no's, honor your goals, and find a way to get that done. But so many people speculate on, well, I'm not going to be able to borrow enough, or it's going to cost too much, or my taxes, or whatever it is, while you're not doing anything. The idea of study long, study wrong. Don't sit and not do anything. Not doing anything is going to get you nothing at all. So I feel like people can get so caught up in the weeds of what does it look like and what is it going to do and what's it going to take, without ever actually asking the right person and finding the steps. This is what we do. It's easy. If you come to me and you want to buy a house, it's not going to be complicated. It's all I do every day. It's going to be really easy. If you come and sit down and need some wealth advising, that's what you do. You're going to be able to put that together. If a person needs insurance, you're going to look at them and say, here's what that looks like. Here's the kind of insurance you need for your goals. So I would just encourage people to ask the questions of the right people, not the person that's not doing it.
Just talk to someone.
Well, it's funny you said that because I do think, and I share this all the time, that I think even our partners are not always the right people, right? We want to talk to our partners. I think you should talk to a professional, as I like to say. So let's say we got the insurance put together. We got the 401k or the set put together. We got pre-approved. We're going to go out house shopping. Now we bought a house. Been living there for 10 years. I bought my house for $300,000. Now I only owe, let's say, $220 on my house. What's that $80,000 considered? What does that mean to me as a homeowner if my house is worth $300,000, or maybe it's now, let's say it's worth $320,000 and I owe $220,000? What is that called? Let's start with you, Richelle.
That's your equity. That's the money. I won't get on a tangent about it. I'll just very simply state that so the image that's up here is a very simple idea of this. Your down payment is the money that you have in the house, is your equity. If you're buying a house and you're not putting your own down payment in, you don't have any equity. If you buy a house, and I always tell people to buy the ugliest house on the nicest block, The reason is because you can go in and improve that house. You can make very simple, subtle changes to the exterior and the interior to bring the value of that house up. Now your house is worth more money. I bought my house 14 years ago. It was like $180,000. My house is worth like $480 now. I have like a $600 mortgage payment. I love it. But the idea of buying the ugliest house on the nicest block, my house is super ugly. It was big, but it was ugly. And I was glad for it. I went in and painted it, took the ugly deck off, did some things. And then my house was immediately, a month later, worth probably $20,000 more. That's why people flip houses. You buy a house, you go in and make some aesthetic improvements to it, and then you sell it to the next person for what that new value is. If you stay in the house, then you're keeping that equity. That's the money, that's the savings account that is in your house. If you don't do that, then your house is really just debt. It will appreciate. And this is the other point I was going to say about the market, stock, investment, and real estate. If you look at it at a micro level, right here, it might be very up and down. If you look at it over the course of history, property goes up, stocks go up. It's going to happen. It's going to happen. That's what it does. So if you make improvements to the house intentionally, you get more equity. If you just wait and sit on it and take care of it, it will appreciate over time. But the equity is the money.
So let's use this scenario. So we have that large amount of equity that you have. Richelle mentioned something. I want to kind of just bring it back to the insurance piece. She bought her house for $180. It's worth now, let's say, $480. What should her insurance look like on her to make sure that if she ever was to borrow it again, let's say she borrowed some of that equity and she took out $100,000 worth of equity. Now she maybe owes $280. The first time she maybe bought insurance, she was only worried about paying $200,000. How do we make sure somebody's properly insured to protect that equity?
Well, when I'm talking to people, I always tell them that there's around 4 or 5 people in your life that you should be on a first name basis with. Your lawyer, your doctor, your accountant, your insurance person. These are people who you need to know. And honestly, these are people who should be seen at minimum once a year. I always tell my clients, we always do what's called a Ep4, a friendly review, at least once a year. Because like I was saying earlier, every year people have babies, people sell their houses, people buy toys, whatever the case may be, it's always something that happens. So, 14 years ago when she bought her house, she got an evaluation of maybe 180, 200, somewhere up in there. If she hasn't talked to or dealt with her agent right now, and that means she's still at, $200K. So if her house were to burn down now, her house may be worth $480. She would only get $200K from the insurance company if that is not steadily updated each year. So basically, your insurance, like I said, doctors, lawyers, kind of stuff like that, these are people who you should at least be checking in with once or twice a year just to say, hey, any updates, anything new going on, anything, have you sold anything, whatever the case may be, always kind of keep an accounting of that stuff.
I like that. So, Tamba, what would you say is the main reason why people maybe don't do that annual review? What is it that, I know we all are busy, but how can we do a better job of making sure the community understands why it's important? And what are some of the reasons you hear people don't come back in maybe once a year?
I think some of it truthfully has to go on us as agents. We have to do a better job. I think people get comfortable in not calling them out. Remember, at the end of the day, we work for our clients. And so they forget, client forgets. So if you're working with someone that isn't doing that, then you probably need to find a new person. That's just being real with people. And I think also it's like as times change, like, hey, you have your life is more expensive, but you're not making more money. People are embarrassed, and they shouldn't be. It's like you've taken a big step by purchasing insurance. Make that work for you and understand that, hey, we are here to work for you. So that's usually what happens is, or they get too comfortable with their person and don't realize that it's still a business. We can be friends, but ultimately I have a financial advisor, even though I am a financial advisor, and I hold him accountable to keep me accountable to my goals. And so I think that's usually what happens is people don't like talk about finances.
I would agree on that, and I would add to this. I think sometimes we cannot be upset if the people, such as our doctor, our lawyer, our insurance person, is calling us or emailing us, sending us stuff in the mail. They're probably telling us that you need to do that check-in, and sometimes I think we're like, oh my gosh, I get all this junk mail, I get stuff. I think it's okay to get that, especially when those people are trying to get in touch with you. I will look at this question again. So we're going to go back to the equity piece because I do think we're protecting the equity. We know we have the equity. What may be a good way to use the equity after we met with Tamba or BJ and protected it? What would be a good way to use our equity in our house?
I mean, you can use the equity in the house. It really is like a savings account. So the difference between what you owe on the house, so your loan is going to steadily go down, and the property should appreciate. So the space between what you owe on the house and the value of it, what you would sell it for now, is your equity. You can take that out and put it into a business, start a new business with it. You can take it out and buy a new property, which is what I love to do. You can take it out if you have kids and use it for your kids' business, their property, their college. And the crux, I see why you read about it back there. The crux of what we're talking about in generational wealth and legacy is that what are we doing right now to be able to plan for the future, and how can we capitalize that? So Tamba, you started off talking about it's the vehicle, it's the understanding and the vehicle of how do we do that. You can conceptually understand something, and I get that all the time. People will tell me high level, here's what you do. And I'm like, okay, sounds great. I get it. And I'll turn around and I'm like, what the hell? What's the first step? Site do I go to? Where do I sign up? What's my first step? So that idea of being able to know that the equity is there, talk to your realtor, talk to your financial planner, talk to your lender. We know how to capitalize on that and take you through the steps of what you can do and what the ramifications of that are. Because there are, every time you move money, right, it impacts something else. So don't do those things in isolation, do those things with the advice of somebody so that you know, if I take this out, what are my consequences for that? But those are the things you can do with it. Anything that you would do with this.
Go ahead, BJ.
Yeah, no, I was just going to say that to me, it kind of sounds like the overarching point, kind of everything that we're saying here is basically talk to the right people. Mm-hmm. You got to talk to the right people. Don't, like you say, don't talk to your spouse or somebody who don't talk to somebody about raising kids that ain't got no kids.
Right.
You know what I mean? You got to talk to the right people. And if you're actually proactive in seeking out that information, that's valuable. That can change circumstances.
So let me ask you this too, because I do think what we're saying is we can't be afraid to ask questions, but we also have to come in with a mindset that nobody's there to judge them, right? You're there to actually help them and help them build long-term financial empowerment and financial wealth for their families. And I think a lot of times in the Black community, we get this image that we're afraid because we're going to be judged. We got to get away from that mindset that we're judging people. I'm going to ask you guys this. What was one thing you learned as a child around wealth creation that you still do to this day? Who would like to go first?
I'll go, because I learned a lot. Like, I realized that I came from probably a weird family now with regard to this, and talking to other people. Like, they sat around and read the stock paper. Like, the newspaper was there and we would talk about it. The stock that we had dictated what we bought. So whatever stock my grandma had in torts were Blaxican. So those were the torts that we were buying because grandma had stock in it. The companies that they worked for, those were the companies that we had stock in. Those were the things that we bought. So I maintain that still. My kids wanted Roblox. I was buying Robux all the time. I'm like, this is stupid. Where does it go? We have Robux stock. I'm like, that'll make me feel better. So now my kids understand that if you guys are going to buy Robux, we're going to have stock in Roblox so that it makes me feel better. When Amazon comes to my door, I feel better about it. I've got Amazon stock, right? So that's what I learned. I learned that my money is my money and I can invest in things. As a stockholder in a company, I look at that very much as part of my company. I care. And I invest in things for that reason. Is this a good company? Mm-hmm. That's what I learned. And I carry it with me. It's one of the things I carry with me.
Okay. I'll let you go next.
I think the thing that I learned is just money is a powerful tool. And you can use it for many good things, whether it's saving it, whether it's tithing it, whether it's just having it so that you can own your own life and what you want to do. So I think people don't understand that you got to work hard for it, but you got to be smart with it, and take the time to at 70, save 70, 20, 10, whatever you want to do, and make sure that you're always going to have a goal when you're making money, because as quick as it comes is as quick as it can go as well.
Mm-hmm.
How about you, BJ?
Yeah, sure. I would say probably revert back to another thing that we were talking about in the hallway, something that my something that my dad basically always told me. I'm trying to make sure I'm doing this right for the camera here, not the way he told me to. But basically, Black folks have, for the most part, we have been taught that we need to do what we have to do to survive, whatever it takes to. A lot of times we don't think, too far ahead. We think to the next paycheck. How do I get there? How do I make sure the kids can get to school? They got lunch money. Make sure we got laundry money. There's the very basic necessities, and anything that's outside of those necessities, it's not something that we can conceptualize on. I have to focus on what's this here right now. That's the way that we have been taught to think. You have whatever you immediately have going on, that's what you have to focus on. Whereas instead of just doing what we have to do to survive, what my dad always taught me was do what you want to do to thrive, to be able to have the kind of life that you want to have, whatever that may be, whether it's, having new cars, new houses, traveling, whatever the case may be, whatever it is you want to do, don't just think about now and immediate. Think about a year down the line, 5 years down the line. Set your goals and write them out. Mm-hmm. So that way you look at them, usually daily or something, and do something every day to work towards those goals.
Yep, I would say my father taught me to save. He was a big saver, and that's one thing I learned about. Money don't grow on trees, mm-hmm. right? You need to save the money, and I would also think, for me, I'm a big person that likes to shop out of season. Right. There's nothing wrong with sales. Mm-hmm. I learned that, all that Christmas stuff you wanted, come January 6th, 8th, is all on 50% off, 30% off. So I've also been learning to teach my daughter how to maybe buy things when they're not in season, yes. But also save your money. So we're gonna kind of wrap up here. What's one takeaway that you guys would like people to take away from today's podcast? And I'm going to really push you to say, in the Black community, the BIPOC community, what is one thing you really would like to see people take away from the podcast today? And I'm going to start with this just real quick. I don't know how many people, hopefully everybody knows who Warren Buffett is, but one thing I've always learned early in life about Warren Buffett, he always says, pay yourself first, right? So I think what we talked about today about the life insurance, the 401k, the 403b, the SEP, we should be paying ourselves first. But what do we want to have people really walk away and say, you know what, that is something I'm going to make sure I start practicing tomorrow? Who would like to go first?
I'll just go real quick. Like I was just saying earlier, talk to the right people. That's the main thing. Seek out that knowledge and that path to go to wherever it is that you want to go. Talk to people who have walked that path already. Basically, don't talk with people that can't help you get to where they at. If you in the same place they are, talk to somebody where you want to get to where they at. Main thing.
Mm-hmm. Wow. Kind of touch on that, just letting people know that your situation is not one that we've not encountered before. So no matter what your situation, you're worth having and betting on yourself.
Yeah. I would echo that. I've had foreclosures. I've had all kinds of stuff happen. One of the things that I taught my kids is, would you rather have money or spend money? And so that's something that I reiterate to them all the time. Have money, don't spend it. And I would just tell people, honor yourself and love yourself enough to do the things that you really want to do. It's one thing to buy a purse because you love yourself. It's one thing to go on vacation because you love yourself. But I feel like that's very superficial. I feel like in our society, that's something that is standard and okay, that passes for self-love. And the reality is, take care of yourself. Plan for yourself. Give yourself the things that you want. Give yourself the opportunity. think about your future self and set yourself up on a good path so you look back and say, man, Richelle, thank you. You living real good at 50. Good job for working hard.
Yeah, I would say that I think I really want people to understand that it's okay to buy life insurance at a young age. Hopefully, you can get it cheaper at a younger age. I would also say that we can't be afraid to talk to a professional, right? Because I think there's a lot of misconceptions in the Black community about how life insurance works, how estate planning works, how 401k or 403b or any type of retirement plan works. So I would say first, let's start to talk to a professional. Then second, sometimes you have to walk that path alone until you find somebody that's willing to walk with you. And I say that because sometimes I do think we let other factors, family members or spouses or partners, talk us out of that meeting when we should just go ahead and make the meeting. One thing I'm also going to share, I learned this quote a long time ago, so I'm also give you guys a chance to share a quote. Rich people live like they're broke, broke people live like they're rich. And I feel like that's one of our problems a little bit in the community. We are so caught up on social media or other things that we're not paying attention to our day-to-day activities of how we can actually live and give people something. Because a lot of times in the Black community, people say, well, I'm dead and gone. Does it really matter what I leave? And we got to get out of that mindset. Well, the mindset has to be that we're willing to leave something for the next generation, then the generation after that. So I'll start with you, BJ. If you could leave a quote also with people to remember, what would you want to leave with them?
Well, towards kind of what we're speaking of, another Warren Buffett quote, as a matter of fact, is he said, if you do not, probably not going to, I'm paraphrasing here, but he says, if you do not learn how to make money while you sleep, then you will work till you die.
Mm-hmm.
And that's one thing that you want to avoid. That's learning. That's if you're just going to, to work and getting the 9-to-5 check and everything, that's great. Put something away. Invest in something that is also going to be making you money as well. Don't just buy things like Richelle was saying. If I go out and buy me a $300 pair of Jordans, I promise you I got at least one Jordan stock. At least one. Just give me one.
Right.
You know what I mean? That way I feel a little bit better about it, like she said. Like don't just buy things that are going to depreciate. Buy things that are also going to appreciate.
I respect that. Tamba, how about you?
And just a simple one, you gotta live for today, but you gotta be willing to plan for tomorrow. Otherwise, you'll be dead today.
Like that. Okay, how about you, Richelle?
I'm terrible at quotes. I'm going to say, do or do not, there is no try. Yoda.
Okay.
Because don't take no's, because do the things that you want to do. There's no, like you were saying about asking the wrong people or your spouse or whoever, is like, no, let's not do it. Do what you want to do. It's your life.
I would agree with that. We appreciate you guys tuning in with us today. This is episode 5 from NAREB. Please stay tuned. We have more coming in the future. Thank you.
MBC. No relation to NBC.